Before we dive in, do me a favor, hit that subscribe button right now. Trust me, you don't want to miss what we're about to cover. I'll remind you again at the end, but go ahead and click subscribe so you don't lose this video. Now, let me ask you a question. Have you ever applied for a business loan and felt like the bank was speaking a completely different language? Like they were judging you based on some secret formula you just couldn't figure out? Here's the reality. In Q2 2025, big banks approved just 13% of small business loan applications. That means 87 out of every 100 business owners who walked into a large bank walked out empty-handed. And here's what's even more interesting: most of those rejections weren't because the business was failing. They weren't because the owner was untalented or the idea was bad. They were rejected because the business owner didn't understand how banks actually evaluate commercial loans. Today, I'm going to pull back the curtain and show you exactly what happens inside a bank's underwriting department. By the end of this video, you'll know the 5 C's of credit framework banks use for every single commercial loan, the key financial metrics that make or break your application, why cash flow matters more than profits, and the one ratio you absolutely must know: how banks price your loan and what you can do to get better rates. The real approval process from application to funding. And most importantly, you'll know exactly what you need to prepare before you walk into that bank. So let's get into it. Section 1: The big picture. What banks really want. Before we break down the specifics, let's talk about the one question that drives every single lending decision a bank makes. Are you ready for it? Here it is. Can this business repay the loan as agreed? That's it. Everything else, every document you submit, every number you report, every meeting you have, all of it exists to answer that one question. Now, here's what most people get wrong. They think banks care about your profits. They don't, at least, not primarily. Profit is an accounting concept. Cash flow is reality. You can have a profitable business on paper and still not have enough cash to make your loan payments. And if you can't make your payments, the bank doesn't care how profitable you are on paper. So banks look at something called cash flow, the actual money coming in and going out of your business. To evaluate this, banks use a framework that's been around for decades. It's called the 5 C's of credit. Let me introduce you to each one. Character: do we trust you to repay? Capacity: can you actually repay? Capital: how much of your own money is in the business? Collateral: what assets will back up the loan? Conditions: what's happening in your industry and the economy? We're going to spend the next several minutes breaking down each of these in detail. Because if you understand what banks are looking for in each area, you can prepare your application to hit every single one. Let's start with the most important one. Section 2: Capacity, the king of the 5 C's. If the 5 C's were a sports team, capacity would be the star player. The MVP, the one that gets paid the most. Why? Because capacity answers the most important question: does your business generate enough cash to repay the loan? Banks will analyze your historical cash flow, your projected cash flow, and debt obligations, how stable and predictable your income is. And they do this by looking at your financial statements, specifically your income statements, balance sheets, and cash flow statements. Most lenders want to see at least 3 years of these. Now, let me show you the single most important number in commercial lending. The debt service coverage ratio, DSCR. The DSCR is the number that keeps bankers up at night. Here's the formula. DSCR equals net operating income divided by total debt service. Let me translate that into plain English. Net operating income is the cash your business generates from operations, before you pay any debt. Total debt service is all the principal and interest payments you need to make on your debts. So the DSCR tells the bank, for every dollar of debt payments you have to make, how many dollars of cash flow do you generate? Here's a real example. Let's say your business has $425,000 in annual net operating income and $275,000 in annual debt payments. $425,000 divided by $275,000 equals 1.54. That means for every $1 of debt you owe, your business generates $1.54 to pay it. Now, what does a bank want to see? Most commercial lenders require a minimum DSCR of 1.20 to 1.25. For a commercial loan in 2025, a DSCR of 1.25x is considered a safe target for stable, low-risk assets. But here's the catch. If you're in a riskier industry, say, retail, restaurants, or anything that took a hit during economic uncertainty, banks might expect 1.30x or higher. In some cases, they might ask for 1.35x to 1.50x. And here's the deal breaker. If your DSCR is below 1.0, that means your business isn't generating enough cash to cover your existing debt payments. No bank in their right mind is going to lend you more money. So before you even think about applying for a loan, you need to. Applying for a loan, you need to calculate your DSCR. If it's below 1.25, you've got work to do. Other key capacity metrics. Banks don't just look at DSCR. They also look at liquidity. Do you have enough cash or assets that can quickly become cash to handle short-term obligations? Net worth. What's the overall financial health of your business? Existing liabilities. How much debt are you already carrying? Think of it this way. A bank wants to know that you can handle the new loan payment plus everything you're already paying. They don't want to be the straw that breaks the camel's back. Section 3. Character. Do they trust you? Alright, let's talk about character. This is the part that a lot of business owners think is subjective, and to some extent, it is. But here's the thing. Banks have gotten really good at measuring character objectively. Character is basically the bank asking, do we trust you to repay this loan? And they figure that out by looking at your credit history, both personal and business. This is often the first filter. Banks will pull your personal credit score, and if it doesn't meet their threshold, your application might not even make it to the next stage. For SBA loans, the minimum business credit score was raised from 155 to 165 as of June 2025. That's how seriously they take this. Your payment history? Have you paid your existing debts on time? Your management experience? Do you have a track record of running a successful business? Your transparency? When banks ask questions, do you answer honestly and promptly? Here's something important. Good character doesn't mean a perfect history. It means consistency, honesty, and accountability. If you've had financial issues in the past, don't try to hide them. Banks will find out anyway. Be proactive. Explain what happened and what you learned from it. One more thing about character. For many small business loans, especially newer businesses, financing is often granted based on personal credit history. That means your personal financial behavior directly impacts your business's ability to borrow. So if you're planning to apply for a commercial loan, check your personal credit report first. Fix any errors, and if there are issues, be ready to Section 4. Capital investment. Now let's talk about capital. Capital is the bank's way of asking, how much of your own money have you put into this business? The more you've invested, the more committed you appear. And the more committed you are, the less likely you are to walk away from the business and the loan. Banks look at owner's equity in the business, retained earnings, liquidity, and net worth. Think about it from the bank's perspective. If you're not willing to risk your own money, why should they risk theirs? Capital shows the bank that you're invested in the business and willing to see it through hard times. Here's a practical example. Let's say you're buying a commercial property for $1 million. You put down $250,000 of your own money and ask the bank for $750,000. Your capital contribution is 25%. That's meaningful. That shows the bank you are committed. But if you ask for $950,000 and only put down $50,000? That's only 5%. The bank is taking almost all the risk. They're going to be much more cautious. How to prepare? Know your balance sheet inside and out. Have a plan for reinvesting in the business. Be ready to show the bank exactly how much you've invested and where the money came from. Section 5. Collateral. The safety net. Know your balance sheet inside and out. Have a plan for reinvesting in the business. Be ready to show the bank exactly how much you've invested and where the money came from. Collateral. This is the bank's backup plan. It's what they can take if everything goes wrong and you can't repay the loan. Collateral is essentially a secondary source of repayment. The primary source is your cash flow. But if that dries up, the bank needs something to fall back on. Common types of collateral include real estate, commercial property, land, buildings, equipment, machinery, vehicles, technology, inventory, products you sell, accounts receivable, money owed to you by customers. Now, here's the key. Banks don't lend 100% of the value of your collateral. They lend a percentage. This is called the loan-to-value, LTV, ratio. LTV equals loan amount divided by appraised value. For commercial real estate, banks typically lend 65% to 75% of the appraised value. For industrial or multifamily properties with strong leases, you might get 70% to 75%. For riskier properties like office space in soft markets, they might cap it at 60% to 65%. For equipment, you might get 50% to 70%, depending on depreciation. For inventory and receivables, it's often 30% to 70%, depending on how reliable and how quickly they turn over. What this means is, if you have a piece of equipment valued at $200,000, you might only be able to borrow $120,000 against it, 60% LTV. Important misconception. A lot of business owners think collateral is the most important factor. It's not. Banks don't want your collateral, they'd rather be repaid. Collateral is a backup, not the primary reason for approval. If your cash flow isn't strong enough, no amount of collateral will get you a loan. The fifth and final C is conditions. This is the bank looking at the bigger picture, things outside your control that could affect your ability to repay. Conditions include the purpose of the loan. What are you using the money for? Industry trends. Is your industry growing or shrinking? Economic conditions. What's happening in the broader economy? Here's a real-world example. In 2025, banks reported tighter lending standards for commercial and industrial loans. Why? Because of economic uncertainty, trade policy concerns, and inflation. If you're in an industry that's considered risky, like restaurants, retail, or early-stage tech, you're going to face more scrutiny. Banks also look at loan purpose. Are you using the money to grow the business? To buy equipment that generates revenue? Or to cover operating losses? Industry health. Is your sector growing? Are there regulatory changes coming? What's the competitive landscape, economic environment? What are interest rates doing? Is the economy growing or contracting? How to prepare. Be able to clearly explain how you'll use the loan funds and how they'll benefit your business. Know what risks your business faces and have a plan for reducing those risks. Be open to structure recommendations from the bank. Section 7 Key financial metrics banks actually use. Now that you understand the 5 C's, let's get into the specific numbers banks look at. Debt service coverage ratio, DSCR. We covered this earlier, but it's worth repeating. This is the most important metric. Most banks want to see at least 1.25. Formula. NOI divided by total debt service. Loan to value ratio, LTV. We covered this in the collateral section. For commercial real estate, expect 65% to 75%. Formula. Loan amount divided by appraised value. Current ratio. This measures your ability to pay short-term obligations. Formula. Current assets divided by current liabilities. A ratio above 1.0 means you have more short-term assets than short-term liabilities. Banks like to see this above 1.5. Leverage ratio. This measures how much debt you have relative to your equity. Formula. Total debt divided by total equity. The lower this number, the better. High leverage means high risk. Interest coverage ratio. This measures your ability to pay interest on your debt. Formula. EBIT divided by interest expense. Section 8 Loan structure. How banks put it all together. Once the bank has evaluated all these factors, they decide how to structure your loan. And the structure matters a lot. Revolving credit. This is best for variable needs, retail stock, receivables gaps, payroll cycles. You borrow what you need and pay it back in cycles. Term loans. These fund longer-term investments, equipment, property, expansions. Amortization. Here's something most people don't understand. The amortization schedule isn't always the same as the loan term. For example, a brewery expanding its taproom might get a 7-year term loan with a 15-year amortization schedule. That means the payments are calculated as if the loan would be paid over 15 years, but the entire remaining balance comes due after 7 years. That final payment is called a balloon payment. Interest-only periods. Some loans start with interest-only payments to ease the initial strain on cash flow. Financial covenants. This is a fancy term for promises you make to the bank. Common covenants include maintaining a minimum DSCR, maintaining minimum cash reserves, not taking on additional debt without permission. About 45% of commercial loan deals in 2025 had springing covenants, covenants that only kick in if certain conditions are met. Section 9 Loan pricing. How banks set your rate. Now let's talk about pricing. How banks decide what interest rate to charge you. Banks price loans based on risk. The riskier you are, the higher your rate. Here's what they consider. DSCR. Higher DSCR equals lower risk equals lower rate. Collateral quality. A Class A office building is better collateral than second-hand equipment. Credit track record, missed payments, tax liens, or lawsuits push your rate higher. Loan to value. Lower LTV equals lower risk equals lower rate. Risk-based pricing. Many banks now use a risk-based pricing model. This means the rate is calculated using a base rate plus a premium based on your specific risk profile. Section 10. The approval process step by step. Let's walk through the actual approval process so you know what to expect. Step 1. Application and initial screening. You submit your application with business information, financial statements, collateral details, and the intended use of funds. Step 2. Documentation and information gathering. The bank asks for more documents. Lots of them: tax returns, bank statements, business plans, personal financial statements. Step 3. Credit analysis and underwriting. This is where the 5 C's come in. The underwriter analyzes everything. Underwriters are the professionals who assess risk. They evaluate your financial history, credit history, collateral, capacity, and the intent. Collateral, capacity, and the intent of the loan. Step 4. Loan structuring and approval. If the underwriter approves, the loan moves to structuring, determining terms, rates, and covenants. Step 5. Closing. You sign the documents, and the money is released. How long does it take? That depends. For existing clients with established history, the process is more streamlined. For new clients, expect several weeks to a few months. Section 11. What's changing in 2025-2026? Before we wrap up, let's talk about what's changing in the lending environment. Tighter standards. In 2025, banks reported tighter lending standards for commercial lending standards for commercial and industrial loans. Banks are more cautious, with big banks approving just 13% of small business loan applications. SBA changes. The SBA has made some important changes. The threshold for 7(a) small loans was lowered from $500,000 to $350,000. The minimum business credit score rose from 155 to 165. Stronger requirements for the credit elsewhere rule, meaning SBA loans are only for borrowers who can't get conventional financing. Fintech competition. Small businesses are increasingly turning to fintech and embedded finance platforms for faster, more flexible access to capital. What this means for you. The bar is higher. Banks are more selective, but if you understand what they're looking for and prepare accordingly, you can still get approved. Conclusion and subscribe reminder. Alright, let's recap what we've covered today. Banks evaluate commercial loans using the 5 C's of credit. 1. Capacity. Can you repay? This is the most important. 2. Character. Do we trust you? 3. Capital. How much skin in the game do you have? 4. Collateral. What's the backup plan? 5. Conditions. What's happening in the bigger picture? The single most important number is your debt service coverage ratio, DSCR. Most banks want to see at least 1.25.1. Your loan to value, LTV, ratio matters too. Expect 65% to 75% for commercial real estate. And remember, banks don't care about your profits. They care about your cash flow. If you take away one thing from this video, let it be this: prepare before you apply. Know your numbers, fix your credit, understand your DSCR, have your financial statements ready. The bank isn't trying to make your life difficult. They're trying to make a smart, responsible lending decision. And the more you understand their process, the better you can position yourself for success. Now, if you found this video helpful, please hit that subscribe button right now. We create content like this every week to help business owners like you navigate the world of commercial finance. Click subscribe, turn on the notification bell, and I'll see you in the next video. Thanks for watching.